Usually when we talk about getting a medical diagnosis, there is this underlying expectation of, well, total precision.
Right, yeah, like it feels almost like engineering or something.
Exactly. Like if you fall and you break your arm, you go to the hospital, they put you in the machine, and the x-ray shows that jagged white line on a black background. And the doctor just points at it and says, there it is.
Right, it's binary. It's a fundamental truth of the physical world. Broken or not broken.
Yeah, it's clean.
Yeah.
And it's comforting. As humans, I think we desperately like things to be visible and, perfectly categorized.
Oh, absolutely.
But then you step into the world of corporate finance and accounting, and suddenly you realize that the x-ray machine itself is completely broken.
It really is.
We're looking at a diagnostic landscape that is, honestly, it's murky. So I want you, the listener, to just imagine this scenario for a second. You are the CFO of a massive company, and you are holding this highly profitable asset. We're talking about an incredible piece of commercial real estate or maybe a booming infrastructure project, and it's generating unbelievable returns.
Sounds great so far.
Right. But because of a tiny technicality in how your company is labeled, literally like the name on the door or the specific legal structure you chose a decade ago, you cannot show those massive profits in your headline numbers.
Oh, man.
Your actual economic reality is completely fundamentally divorced from your reported financial reality.
Yeah, it is the absolute definition of diagnostic muddy waters. I mean, you could literally have two identical companies sitting right next to each other with the exact same economic performance, the exact same cash flows, the exact same assets. But because one happens to be labeled a, say, venture capital organization and the other is a property investment group, they look completely different to the market. The X-ray shows two entirely different skeletons.
And that is exactly the broken machine we are fixing today. Welcome to the Deep Dive.
Yeah.
Today we are looking at CMA Sharik Siddique's The Complete IAS 28 Fair Value Option Guide.
It's an incredible resource.
It really is. Sharik Siddique is the managing partner at SRS Tax Management Consultancy, LLP. And he has put together something amazing here. We are basically ripping up the old rules of accounting eligibility because a massive collision with a new standard called IFRS 18 is about to completely rewrite how corporate profits are reported around the globe.
Yeah, and what he has done in this guide is phenomenal. He has taken the bare standards, I mean the actual highly dense amendments issued by the International Accounting Standards Board on June 26, 2026, and he translated them.
Thank goodness.
Right. Translated them into a highly practical, plain language desk reference.
And we are going to unpack all of it.
Yeah.
We're looking at this monumental shift from relying on an arbitrary label on your business card to actually looking at your business activity.
The underlying reality.
Exactly. We're going to walk through his incredibly detailed work examples, explore the transition rules, and unpack that unavoidable collision with IFRS 18.
It's an essential roadmap for any financial professional. Because look, this IAS 28 amendment, it isn't happening in a vacuum. It goes live at the exact same time as IFRS 18, which is mandatory for periods beginning on or after January 1st, 2027.
Wow, so they are totally linked.
Yeah, if you get one wrong, the other just falls apart entirely.
Okay, now, before we really get into the weeds here, a crucial disclaimer for you listening. We need to be very clear. The views, interpretations, and all these examples we were discussing today, they're compiled from the original bare standards for educational purposes.
Right, educational only.
Yeah, to go back to our medical metaphor, reading a fascinating medical textbook on open heart surgery does not make you a cardiothoracic surgeon.
Please don't do surgery based on a deep dive.
Exactly. You must double-check your specific facts with your auditors, your tax team, your professional advisors before applying a single thing we discussed today. Because the examples we are going to use are illustrative, but real-world corporate structures are, infinitely complex and customized.
Highly customized, yeah.
Okay, let's unpack this. We're talking about IAS 28, which covers investments in associates and joint ventures. But before we get to the new rules, we really need to set the stage a bit.
Make sure we're on the same page.
Yeah, because if our audience is listening to this, they likely already know what a joint venture or an associate is.
Yeah.
That kind of messy middle of having significant influence, usually between 20 and 50% voting power, but not outright control.
Right.
But what I want to know is, why was the old accounting system for this middle ground so spectacularly broken?
Well, what's fascinating here is that this whole debate, it isn't just about math. It's really about how companies are allowed to tell their financial story to the world.
The narrative.
Yes. Historically, if you held an associate or a joint venture, the default accounting method was the equity method.
Right, which I always think of as one-line consolidation.
Exactly. Under the equity method, you start with what you paid for the stake. Then every year, you kind of peer inside the investee's books.
Okay.
You add your share of their internal profit, you deduct your share of any losses, you deduct any dividends they actually handed you, and you adjust for your share of items in their other comprehensive income.
Got it.
So your carrying amount on your balance sheet is basically just tracking your slice of the investee's net assets.
So it's completely decoupled from what the stake is actually worth in the open market, right?
Totally decoupled.
I always like to compare the equity method to watching your friend's bank account grow. Like, you know there is money in there, you know you have a legal claim to a percentage of it, but until they actually hand you a dividend check, it's just a theoretical number on a page.
That's a great way to put it.
It's slow, steady, and honestly, a bit boring.
Yeah.
But there was an alternative, wasn't there?
There was. The fair value option. This lets an eligible investor completely ignore the equity method.
Just throw it out.
Throw it out. Instead, they measure the associate or joint venture at fair value through profit or loss, often abbreviated as FVTPL. You look at the asset under IFRS 9 and measure its actual market value under IFRS 13.
Okay, let's drill into the mechanics of that for a second because it radically changes the financial narrative.
Yeah.
How does fair value alter the income statement?
Drastically. With fair value, you aren't peering into their internal books anymore. You essentially put a black box over the investee company.
Okay, the black box.
Yeah, you only care about the sticker price on the outside of that box. Every single movement in that sticker price, whether the market value goes up or down, it goes straight through your profit or loss statement immediately.
Wow, right away.
Right away. Dividends are just treated as standard income when the right to receive them arises. You aren't calculating your share of their internal profit, you aren't dealing with goodwill hidden inside the carrying amount, and you don't do a separate impairment test at all.
Because it's all baked into the price.
Exactly. You just look at what the asset is worth today versus yesterday. That difference is your gain or loss.
It's like checking the Zillow estimate of a house you co-own.
Yes.
You don't care how much money your co-owner spent on groceries or maintenance that month. You don't care about the internal plumbing. You just care if the market value of the house went up by $50,000.
Exactly.
If it did, boom, you record that $50,000 gain right now.
That is a perfect analogy. And naturally, these two methods, the bank account versus the Zillow estimate, they produce entirely different numbers.
I imagine.
Yeah, Sharik Sadiq provides a very stark illustration in the guide. Imagine you buy a 30% stake in a company for 1,000 currency units, or CU.
Okay, 1,000 CU.
Right. Under the equity method, let's say they make a profit. You take your 90 CU share, deduct a 40 CU dividend, and your carrying amount slowly climbs to 40.65.
Okay, so it creeps up.
Yeah. And your recognized profit on your income statement is just that 90 CU.
Right. Slow, steady, smoothed out.
But under the fair value option, let's say the market absolutely loves this company. The fair value of that stake jumps to 5,510.
Whoa!
Yeah. You recognize that entire 210 CU gain immediately, plus the 40 CU dividend, giving you a total recognized profit of 250 CU.
That is a staggering difference.
Okay.
90 CU versus 250 CU for the exact same underlying asset in the exact same year.
Same asset, same year.
So looking at that, obviously every single CFO on the planet wants to use the fair value option if their assets are going up, right?
Of course they do.
But they couldn't.
No, they couldn't.
The old IAS 28 paragraph 18 had what was essentially a velvet rope.
It was a very strict VIP list, and this was the root of the whole label problem. The old rule was based entirely on the legal or structural type of entity holding the investment.
Name on the door.
Right. You were only allowed into the Fair Value Club if you were a venture capital organization or mutual fund, unit trust, and similar entities.
Wow. It was an entry policy based entirely on what was printed on your business card.
Exactly. If you didn't carry one of those highly specific labels, you were bounced by the bouncer and you defaulted to the equity method.
No fair value for you.
Nope. Now, the standard did specifically mention investment-linked insurance funds as an example of a similar entity. But that phrase, similar entity, it was incredibly vague.
I can imagine the arguments over that.
Oh, years of endless arguments between CFOs and auditors. Two companies with almost identical underlying businesses could reach completely opposite conclusions about whether they qualified.
Just based on how they interpreted similar entity.
Yep.
So who was left out in the cold here? Like, who was knocking on the door of this VIP club and getting rejected?
Some of the absolute biggest players in the global economy, honestly. listed investment property groups that held massive billion-dollar portfolios through joint arrangements with co-investors,
Oh, wow.
sovereign wealth funds, pension investment companies holding massive 30% stakes in infrastructure projects,
Yeah.
investment holding companies whose entire strategic purpose is to buy, hold, and sell minority positions.
Huge portfolios.
Massive. And corporate venture arms that acted exactly like VCs but just weren't formally structured as a standalone fund.
That feels incredibly frustrating. I mean, imagine you run an investment property group. Your entire reason for existing on this earth is to invest in real estate and ride the capital appreciation.
Right.
But because your corporate charter doesn't specifically say mutual fund, you have to use the equity method.
It's crazy.
You have to measure your performance based on a slow trickle of rental profit rather than the actual fair value of the skyscraper you just bought. It's totally misaligned with how you judge your own performance.
It was a massive unfairness gap. A rule written as a static list of names simply could not survive the reality of complex modern corporate structures.
No, obviously not.
But here's the thing. It was a tolerable annoyance for years. Companies grumbled, CFOs complained at conferences, but they dealt with it.
Until they couldn't. Which brings us to the catalyst for all of this. The label problem was an annoyance, sure, but why did the IASB suddenly go into emergency mode and rush to fix this on June 26, 2026? What sparked the panic?
Because a massive, slow-moving train was heading straight toward them, IFRS 18 entered the chat.
Here's where it gets really interesting. Because IFRS 18 is a total game changer for the income statement, right?
It is the biggest shakeup to presentation in decades. IFRS 18, which is titled Presentation and Disclosure in Financial Statements, officially replaces IAS 1.
Okay, big deal.
Huge deal. It introduces strict, mandatory categories in the income statement. Every single item of income and expense must now be classified into one of three buckets: operating, investing, or financing.
Operating, investing, financing.
Right. And crucially, for the first time, it requires a compulsory standardized operating profit subtotal right on the face of the income statement.
Okay, so you have these three strict buckets. Operating is the gold standard, right? That's what analysts look at.
Exactly.
Investing is kind of the side hustle bucket. Financing is how you pay for it. So where is the collision with IAS 28?
The trap lies in how IFRS 18 treats the equity method. The new standard dictates that results from associates and joint ventures accounted for by the equity method must be pushed into the investing category. Always.
Wait, always? Are you sure? Like, no exceptions?
Always. Unconditionally. Even if that investee is literally the company's core primary business.
Oh, wow. Okay, let's play this out because that sounds bad. What does this actually mean for that property investment company we just talked about?
Yeah.
The one that was locked out of the VIP room and forced to use the equity method.
It would be an absolute disaster for them. Without this amendment, an investment company forced onto the equity method would report an operating profit that excluded the very activity it exists to carry on.
Wait, really?
Think about it. Their core business returns, the profits from their massive property joint ventures, would be shoved down into the investing category below the headline operating profit line.
The Wall Street analysts would open their financial statements, look at their operating profit, see a number close to zero, and think the company was failing. Because the numbers that actually matter, the numbers that prove the executives are doing a good job, are hiding in the wrong bucket.
Yes, trapped below the line.
That is a nightmare scenario for a CFO.
Yeah.
You'd have to spend the first 30 minutes of every single earnings call aggressively explaining why your operating profit doesn't actually reflect your operations. Like, please ignore the bold number on page 1. Look at page 7, footnote C.
Nobody wants to do that. And as companies started running dry runs, prepping for IFRS 18, they realized this collision was going to happen. Panic set in.
I bet.
They started reading that old similar entity phrase in the old IAS 28 very, very creatively to try and force themselves into the fair value option just to save their operating profit metric.
Trying to sneak past the bouncer.
Exactly. And the IASB saw this incredibly inconsistent practice taking root globally and realized they had to step in and fix the gateway before IFRS 18 went live.
So how do they fix it? Did they just throw up their hands, open the floodgates, and say anyone can use fair value?
No, they didn't open the floodgates. The IASB explicitly rejected an unrestricted option.
Why?
They felt that if every single manufacturing or retail company could just fair value their random associates, It would introduce way too much volatility into the market. Instead, they completely rewrote the eligibility criteria. They shifted from entity labels to business activity.
I love that. It makes so much intuitive sense. So what is the new test?
The fair value option is now available to any company that has a specified main business activity, or SMBA, of investing in particular types of assets.
SMBA.
Right. That concept, SMBA, is borrowed directly from the new IFRS 18 standard. So you don't need your charter to say mutual fund anymore.
Okay.
You just need to prove to your auditor that your main business, your day-to-day reality, is actually investing in assets with a view to generating returns from capital appreciation or investment income.
That is a massive relief for all those property groups and sovereign wealth funds. They can finally be judged on reality, not labels. But wait, you mentioned they didn't open the floodgates. If I prove that my main business is investing and I elect fair value, do I automatically get to put those massive gains in my operating profit bucket?
And this is where the guide issues its biggest warning. This is the trap that is so incredibly easy to miss, and it's why getting professional advice is critical.
Uh-oh.
Getting the fair value option does not automatically buy you operating classification. There are two entirely separate hurdles you have to clear.
Wait, hold on. If my whole company exists just to invest, aren't all my assets investments by default? Why do I even need a second hurdle? Walk me through this decision path.
Because corporate structures are messy. Hurdle 1 is at the entity level. Does the reporting entity preparing these financial statements have a specified main business activity of investing in assets?
Okay, the SMBA test.
Right. If the answer is yes, great. You have unlocked the door to fair value. But you aren't done. Hurdle 2 is at the asset level. Is this particular investment held as part of that investing activity?
Give me an example of how you pass hurdle 1 but fail hurdle 2.
Sure. Let's say you are a massive investment fund. Your main business is clearly investing.
Pass hurdle 1.
Past hurdle 1. But to run your global operations efficiently, you set up a joint venture with another company specifically to handle all your internal back office IT and payroll services.
Ah, I see where this is going.
Right. That IT joint venture is not held to generate capital appreciation or investment income. You didn't buy it hoping the value of payroll software goes up.
No, you hold it for operational support.
Exactly. So even though you are an eligible entity and you can measure that IT joint venture at fair value, the gains or losses from that specific joint venture would go into the investing category, not operating, because it fails the asset level hurdle.
That is a vital distinction. Electing fair value is about measurement, right?
Yeah.
How we calculate the number.
Yeah,
And IFRS 18 is about presentation, where we put the number on the page. You have to win both games to get your gains into operating profit.
Beautifully summarized. And to make it even more complex, eligibility to elect fair value is tested at the level of the entity that holds the investment.
Okay.
But presentation classification is tested at the level of the entity that reports. In a large multinational corporate group, those are almost always two different entities.
Okay, my head is starting to spin with theory. I feel like abstract rules mean nothing until you actually try to apply them. We need to stress test this.
I agree completely, and that is why the real magic of Sharik Steek's guide is the 9 illustrative worked examples. He doesn't just give you the rule, he forces you to walk through the logic.
Let's do exactly that. We're going to linger on these details because this is where the theory actually hits the balance sheet. Let's start with the clear winners. Example 1 in the guide, Horizon Realty Holdings Play.
Horizon is the classic textbook beneficiary of this amendment. They are a listed group, and they're stated public business is owning and managing commercial real estate.
Classic property group.
Right. About half their property portfolio is held directly by the parent, and half is held through joint ventures. Let's say they hold a 40% stake in a massive project called Riverfront Mall JV.
Okay, so under the old rules, Horizon is completely out of luck. Bouncer turns them away. They aren't a venture capital fund, so they have to use the equity method for the Riverfront Mall.
Right. Now let's look at their income statement under the old rules, assuming they merged with the new IFRS 18 categories without this fix.
Okay, lay out the numbers.
Let's say their direct rental income from the properties they own 100% is 500 currency units.
500 CU, got it.
Their share of the Riverfront Mall JV's internal profit is 90 CU. Under IFRS 18, that 500 CU from direct rentals is safely classified as operating profit. But that 90 CU from the JV, Because it's on the equity method, it is unconditionally banished to the investing category. Their headline operating profit is locked at 500.
Even though joint ventures make up literally half of their entire business model, that is the exact nightmare scenario we talked about earlier. Wall Street thinks they are half as profitable as they actually are.
Exactly. Now let's look at the new world under the amended IAS 28. First, hurdle 1. Does Horizon have a main business activity of investing in assets?
Yes, clearly.
They clear the entity hurdle. Hurdle 2, do they hold the Riverfront Mall as part of that activity?
Yes, it's a core investment.
They clear the asset hurdle, so they elect the fair value option.
And what happens to the math?
The fair value of the mall went up this year. Under fair value measurement, let's say the change in market value is a 160 CU, and they received a cash distribution of 50 CU. That is a total gain of 210 CU.
Okay, 210 CU.
Because they cleared both hurdles, that entire 210 CU moves up the income statement directly into operating profit.
Whoa, so their headline operating profit jumps from 500 CU to 710 CU.
Yes. And it's vital to understand they experience a double effect here. They experience a measurement effect, right? The number itself changes from 90 to 210.
Right.
And they experience a presentation effect, meaning it moves from below the line to above the line. It completely transforms their financial narrative.
That is a massive, massive win for property groups. The CFO is literally doing cartwheels in the hallway.
Yeah.
But what about the insurance industry? Let's look at example 2, Zenith Life Assurance. Now, I read the guide closely, and it noted that the old standard specifically used investment-linked insurance funds as an example of an entity that was allowed to use fair value.
Yes, it did.
But the new amendment deleted that example. Didn't insurers just lose their VIP pass?
It looks like a huge loss on paper, but if you look at the mechanics, it's actually a much broader win. Let's look at Zenith Life. They run unit-linked business through mutual funds, but they also hold a 28% associate, let's say it's a specialist asset manager, in their own corporate shareholder portfolio. Under the old rule, they could easily use fair value for the linked funds, but that shareholder portfolio associate was a massive gray area. Did the insurance fund exemption stretch that far? CFOs and auditors fought about this constantly.
So why on earth did the IASB delete the example? It seems like they just made it harder.
Because they don't need a specific carve-out anymore. IFRS 18 explicitly identifies insurance entities as businesses that may invest in assets as a main activity.
Oh, I see.
So Zenith doesn't need to point to a narrow footnote. They just test themselves against the general rule. And since their main corporate business includes investing in assets to back their liabilities, they can elect fair value for any of their qualifying associates and joint ventures.
Ah, so both the linked fund holdings and the shareholder portfolio associate are now clearly eligible.
Exactly. The route to eligibility changed, but the destination is much, much more secure.
Okay, that makes sense. Let's pivot to the old guard. What about a traditional venture capital fund? Example 3 is Meridian Ventures. They've been using fair value for their 20 to 35% tech startup stakes for a decade under the old rules.
For them, the measurement aspect doesn't change at all. The amendment explicitly preserves the rights of existing users. If you are a venture capital organization, a mutual fund, or a unit trust, you keep your existing elections and your carrying amounts.
So the Meridian CFO can just put their feet up and take the rest of 2026 off.
I wouldn't recommend it.
No.
No, they have no transition adjustment for the IAS 28 measurement, sure, but they still have a massive IFRS 18 presentation project.
Oh, right, the buckets.
Yeah, they have to rigorously confirm operating classification for every single investment based on those new category rules. Just because you measure it at fair value doesn't mean you automatically get operating profit. The measurement is settled, but the presentation requires a ton of documentation.
All right, let's get into the really sticky stuff. The complex group dynamics. This is where I think heads are going to spin a little bit. I want to look at example 4, Apex Industrial Group.
Okay, Apex.
They are a conglomerate that manufactures automotive components. That's a classic heavy metal manufacturing setup. But they are big enough that they have a wholly owned subsidiary called Apex Capital Ltd., which acts as the group's internal investment arm.
Right.
Apex Capital holds a 25% stake in a fast-growing software associate called Nimbus Tech. The fair value of Nimbus Tech jumps from 400 CU to 520 CU.
This example perfectly illustrates why you must ruthlessly separate the two hurdles. Let's look at eligibility first. Eligibility is decided at the level of the specific subsidiary that holds the investment. So we look at Apex Capital Ltd. What is Apex Capital's own business?
Investing in assets.
Right. Therefore, As a standalone entity, it is eligible. It can elect the fair value option for Nimbus Tech.
Okay, so they secure the fair value measurement. That 120 CU gain is officially recognized, but where does it go on the income statement?
That depends entirely on whose financial statements you are reading. Let's look at the consolidated financial statements for the whole Apex Industrial Group. The reporting entity here is the parent group. What is the group's main business activity?
Manufacturing automotive components. Stamping metal.
Correct. The consolidated group does not have a main business activity of investing in assets. Therefore, in the consolidated IFRS 18 income statement, that 120 CU fair value gain must be presented in the investing category. It absolutely does not go into operating profit.
Wow. Okay, need to pause here. So the subsidiary was perfectly eligible to measure it at fair value, but the parent's core manufacturing business dictated that those massive gains couldn't be called operating profit in the consolidated view.
Exactly. Getting a yes on eligibility does not deliver operating classification. You can have fair value measurements sitting right there in the investing category.
That is going to catch so many controllers off guard. You
Yeah.
literally have to write out that two-level analysis, like who holds it and who is reporting it, for every single indirectly held investment in a massive conglomerate.
It is a massive mapping exercise.
Let's look at example 5, which kind of flips this logic on its head a bit. Crestline Capital. They are a pure-play investment company. They hold 30% of Harbor Logistics Park specifically to generate returns, and they hold 45% of Crestline Shared Services, which is a joint venture providing internal IT support back to Crestline itself.
Right. So Crestline clears the entity-level hurdle 1 with flying colors. Their main business is undeniably investing. But remember hurdle 2, the asset-level test. You have to assess this for each specific investment.
So for Harbor Logistics Park,
It is clearly held as part of the investing business to generate capital appreciation. So fair value gains go straight to operating profit.
and the Shared Services IT joint venture.
That is an operational arrangement. It just happens to be legally structured as a joint venture for tax or liability reasons. It is absolutely not held for investment returns as part of their main investing activity. So even though Crestline is a fully eligible entity and can measure it at fair value, the gains from that IT joint venture go into the investing category.
So you have one single company using the exact same fair value accounting method for two different joint ventures. And it has to put the results into two entirely different categories on the exact same income statement.
Precisely. Fair value measurement does not automatically mean operating classification, even within an eligible pure play investment company.
Okay, let's make it even more complicated. Example 6, Sterling Group. This one honestly sounds like absolute madness.
It's a fun one.
Sterling manufactures packaged foods. They hold a 35% stake in a startup called Delta Foods, but they don't hold it all in one place. The manufacturing parent company holds 20% directly, and their internal investment arm subsidiary, Sterling Ventures, holds the remaining 15%.
Right. This is what we call a split holding. The total 35% gives the group significant influence, making Delta an associate under IAS 28. Now, the amendment, specifically paragraph 19, allows you to split the accounting.
Wait, really?
Yeah. The 15% held through the eligible investment arm can be elected for fair value. The 20% held directly by the manufacturing parent must stay on the equity method.
Wait, so in the consolidated financials, you are using two completely different accounting methods for the exact same associate.
Yes.
That's like tracking half your diet in calories and the other half in Weight Watchers points and then trying to tell your doctor how much you ate. How does an auditor even begin to sign off on a consolidated book like that?
It sounds chaotic, but it is completely legitimate, and it has actually always been permitted for these specific, highly structured corporate groups. But you are right to point out the practical reality. Two bases for one investee means running two separate ledgers, maintaining two distinct disclosure trails in the footnotes, and creating a massive, highly complex reconciliation headache that your auditor is going to scrutinize with a microscope.
And what's the payoff for all that headache? Where do the numbers go?
That's the tragic irony here. Because the Sterling Group as a whole makes packaged food, not investments, both the equity method portion and the fair value portion will end up classified in the investing category anyway.
Oh, man. So they do all that work, run two ledgers, fight with their auditor, and it doesn't even help their operating profit.
Exactly. Sometimes, just because the standard allows you to do something complex doesn't mean it's strategically wise to actually do it.
Yeah, note to self, don't do that. Okay, let's talk about the transition because this is a one-time window and it sounds terrifying. Example 7, Northgate Infrastructure. They are transitioning to IFRS 18 for the year ending December 31st, 2027. They want to move a 35% infrastructure associate from the equity method to fair value.
This is critical, and it's where the timeline gets aggressive. The switch is retrospective under IAS 8. You have to restate your comparative financials as if fair value had always been used.
Oh no.
If 2027 is your first IFRS 18 year, your comparative year is 2026, which means your opening balance sheet date for the restatement is January 1st, 2026.
Okay, let's look at the math Sharik Siddiq provides because the numbers are huge. On January 1st, 2026, the old equity method carrying amount was 900 CU, but they calculate that the fair value on that exact date was 1150 CU.
Right, so it's a 250 CU uplift. That entire 250 CU goes straight into your opening retained earnings on January 1st, 2026. It's a massive one-time boost to equity.
It's a huge drop into equity. And for the 2026 comparative year itself, under the old equity method, they had recognized 80 CU of profit. But the fair value jumped over the course of 2026 from 1150 to 1,320. So that's a 170 CU gain.
So in the restated 2026 income statement, you do two things. First, you completely remove that 80 CU equity share from the investing category. Second, you insert the new 170 CU fair value gain into the operating category.
So net, your restated profit for 2026 increases by 90 CU, and your operating profit looks vastly stronger.
That's exactly right.
That sounds incredible on paper.
Yeah.
But I'm thinking about the real-world logistics. If I'm a CFO doing this transition project in, say, mid-2027, I need a highly defensible, auditor-approved fair value for January 1st, 2026. For an unlisted associate, that means conducting a complex valuation exercise for a date that is already 18 months in the past.
And that is exactly why companies are panicking and why Sharik Siddiq emphasizes taking action immediately. You cannot wait until 2027. We will get into the nightmare of retrospective valuations more in the action plan, but you are right to be terrified of that timeline.
Let's hit the last two examples to round this out. Example 8, Vantage Investment Group. This highlights the friction between separate, standalone financial statements versus consolidated group statements.
Right. Vantage Paul is the parent holding company. It merely holds subsidiaries and provides management services. But the group as a whole, looking at all its subsidiaries, is a massive investing group.
Right.
If the group elects fair value for an associate in the consolidated statements, IAS 27 requires the parent company to use the exact same measurement in its separate, standalone financial statements.
Measurement travels. If you fair value it in the group, you fair value it at the parent.
Measurement travels. But, as we've learned, classification might not. The group's main activity is investing in assets, so in the consolidated view, those fair value gains are operating profit. But the parent company, standing alone, might just be a management entity.
Its own main activity isn't investing in assets, it's providing management services to its subsidiaries.
Exactly. So in its separate, standalone financials, that exact same fair value gain might be forced down into the investing category.
Which means if local tax laws or regulators require you to file separate standalone financials, your operating profit in the standalone book will look totally different, maybe massively lower than the consolidated book.
Yeah.
We're going to have to sit in a room and explain that discrepancy to a very confused regulator.
Yes. Prepare that explanation well in advance because the optical difference will be jarring.
Finally, example 9, Sonora Cements. They make cement. It's a heavy physical business. They hold a 30% joint venture in a grinding unit. They have no internal investment arm. What happens to them?
For Sonora Cements, nothing changes regarding ISS 28 measurement. They were not eligible for fair value before, and they are not eligible now. They stay squarely on the equity method.
Okay, simple enough.
However, and this is crucial, they still face the massive IFRS 18 presentation change. Their equity method share of profit from that grinding unit will be mandated into the investing category, presented below their operating profit.
So even if the ISS 28 amendment doesn't give you a new option, IFRS 18 still rearranges all your furniture. Operating profit changes for almost everybody, even pure manufacturers.
Precisely. No one escapes the IFRS 18 blast radius.
Okay, let's pull back from the raw math for a second and look at that blast radius. We are moving into the impact map and demographics. Part 7 of the guide outlines exactly who this applies to. We know it hits investment property groups, insurers, pension schemes, sovereign wealth funds.
Yeah, all of them.
But the guide has a very specific, detailed note on the position for India. Let's talk about that.
This is a crucial geographic nuance that affects a huge number of global companies. Indian companies governed by the company's rules apply Ind AS 28. Currently, Ind AS 28 is fully converged with the older version of IRS 28. It still has the old entity label test. And India hasn't yet notified a local equivalent to IFRS 18.
So Indian companies can just ignore this entire conversation.
Absolutely not. While there is no immediate regulatory change for Cure Local reporting, thousands of Indian preparers are profoundly affected right now.
How so?
If you are an Indian subsidiary of a foreign parent that reports under IFRS, say a UK or European multinational, your group reporting pack has to be prepared on IFRS 18 lines. The parent's global transition dictates your local timeline.
Right. The parent needs your numbers in the new format so they can consolidate. You don't get to opt out just because you sit in Mumbai.
Exactly. The same goes for Indian companies seeking overseas listings or entities operating in Gift City that are permitted to report under full IFRS. And frankly, even for local Ind-AS companies, this amendment is the clearest indication of where Indian standards will inevitably go.
It's writing on the wall.
The guide strongly advises Indian investment-type entities like REIT sponsors or NBFC investment companies to run this eligibility test as a dry exercise today.
Because rebuilding historical fair values years after the fact is incredibly expensive and prone to error. Do the math now, put the valuation model in a drawer, and be ready for when the local standards catch up.
That's the smart strategic play. Don't wait for the regulators to tap you on the shoulder.
Let's talk about the 10 impacts outlined in Part 8, because accounting doesn't happen in a vacuum. Changing these numbers creates a massive structural ripple effect across the entire business ecosystem. Let's start with the most obvious one, earnings volatility.
Here is where it gets really interesting and dangerous. The equity method, for all its flaws, is a wonderful smoothing mechanism. It dampens the noise of the market.
Right.
If your investee makes a steady 5% profit every year, you report a steady 5% profit regardless of whether the broader stock market is booming or crashing.
But fair value strips away that shock absorber.
Completely. Fair value swings hit your profit or loss immediately and in full. If the market tanks, your asset value tanks, and that massive paper loss hits your income statement right away, there is zero smoothing.
Imagine a year where the commercial property market dips slightly.
Yeah.
Just to chill in the air. Under the equity method, maybe you still show a steady trickle of rental profit from your JV because the tenants are still paying rent.
Sure.
But under fair value, your operating profit suddenly crashes because the capital value of the skyscraper dropped by 10%, even if your actual cash flow is perfectly fine.
And that leads directly to severe real-world consequences. Think about commercial loan covenants. Almost all corporate loans have covenants tied to operating profit or EBITDA margins.
Oh, wow. I hadn't even thought of that. So a company's underlying economics haven't changed by a single dollar. You have the same cash, the same buildings, the same tenants.
It's nothing physically changed.
But simply because they adopted this accounting change, their operating profit becomes incredibly volatile, and they could suddenly breach a multi-million-dollar loan covenant.
Yes. A paper loss could trigger a technical default, allowing a bank to recall a loan. Or, conversely, they might hit a massive windfall. Think about executive bonus schemes.
Oh, boy.
If a CEO's long-term incentive plan triggers when operating profit hits a certain threshold, and this presentation change suddenly moves 200 million CU of fair value gains above the line.
The CEO might get a massive multi-million-dollar payout entirely due to a change in accounting standard phraseology.
Exactly.
That is wild. The CFO literally has to read every single covenant definition and every single executive incentive plan before pulling this trigger. They have to know if the contract is written on frozen GAAP or floating GAAP.
And you have to rewrite your analyst KPIs. Operating margin, return on capital employed, earnings per share commentary, it all shifts fundamentally. You need to build a KPI bridge and explain it to your investors months before results day.
Because if you surprise the market with crazy new numbers, the market will panic and sell your stock.
Yeah.
What about the valuation infrastructure itself? Because you can't just guess fair value. You can't just ask the CEO what he thinks it's worth.
Exactly. IFRS 13 requires rigorous, defensible fair value measurement. For unlisted associates, this usually means relying on Level 3 unobservable inputs. You have to appoint independent valuation experts, agree on complex methodologies like discounted cash flows or comparable multiples with your auditor.
So it's a whole new process.
And budget for this as a permanent recurring cost. It's not a one-off project. It's a new operational overhead.
The guide also points out a fascinating loss of information. We touched on this earlier, but what exactly vanishes from the balance sheet when you switch to fair value? Explain the mechanics of why we lose this data.
Several crucial things disappear, and it's because of the fundamental nature of the two methods. Under the equity method, as we said, you are peering inside the company's books. So if the investee revalues its own properties, creating other comprehensive income, or OCI, you record your share of that OCI.
So you have visibility into their equity structure.
Right. You also separately track any goodwill you paid when you bought the stake.
But fair value puts a black box over the investee.
Exactly. With fair value, you only care about the external market price of the stake. You lose all visibility into what's happening inside. So you no longer record a share of the investee's OCI. There is no more goodwill line item sitting inside the carrying amount because the market price inherently subsumes goodwill.
Makes sense.
And there is no separate impairment testing because any impairment is automatically reflected in a lower fair value.
And distributions. We touched on this, but it's vital to get right.
Under the equity method, receiving a dividend reduces your carrying amount on the balance sheet. It's like taking money out of the ATM, your balance goes down.
Right.
But under fair value, a distribution is recognized simply as dividend income when the right to receive it is established. If you don't update your chart of accounts in your consolidation software, you risk double counting income in the transition period.
And then there's tax.
Yeah.
Because there is always tax.
Always tax. Deferred tax on the investment may change significantly where the carrying amount diverges from the tax base. And recognizing distributions as direct income might interact wildly with local participation exemption rules or alternative minimum tax calculations.
So bring in the tax folks early.
You have to involve the tax team at the very beginning, at the modeling stage, not at the end when the accounts are already drafted.
The guide ends this section with a very uncomfortable question. I want to pose it to you because it gets to the heart of human behavior. Is a company choosing fair value because it reflects how the business is genuinely managed? Or are they just trying to flatter their operating profit in a rising bull market?
That is the philosophical core of this entire amendment. Corporate incentives are a powerful, dangerous drug. If a CFO knows that electing fair value will instantly double their operating profit and trigger their bonus in a bull market, they will be highly motivated to argue that their main business activity is investing, even if they mostly make widgets.
They will twist their corporate narrative to fit the rule. They will reverse engineer the strategy.
Exactly. But the answer to that uncomfortable question will be tested. It will be tested first by a skeptical, highly trained auditor who will demand hard evidence. Board minutes, internal reporting structures, executive KPIs.
They want the receipts.
And more importantly, it will be tested by the brutal reality of the market in the first year that asset values fall. Because this choice is effectively permanent outside the transition window.
You can't just flip back.
You can't ride the fair value wave up for 3 years and then quietly switch back to the equity method when the market crashes to hide the losses. You have to make the choice based on true economic reality, not short-term vanity.
Which is a perfect segue into the playbook, checklists and timelines. If you are a CFO, controller, or auditor listening to this, you need to know exactly what to do when you get to the office on Monday morning. Part 9 of the guide gives us a 6-step eligibility checklist.
Let's run through it. Step 1. Is it genuinely an associate or joint venture? Check your voting rights, your shareholder agreements, and board representation. Don't assume.
Good first step.
Step 2. Which entity actually holds the investment? Look at the immediate direct legal structure, not just the ultimate parent at the top of the org chart. Step 3. Does that specific holding entity have an SMBA of investing in assets?
And here's where the guide adds a massive note on judgment. How do you actually prove that to an auditor?
It's not a strict mathematical percentage test. You can't just say, well, 51% of our revenue is from investments, therefore we qualify. It is based on how the business is actually managed day to day. You have to look at board-approved strategy documents.
Okay.
Look at how management is remunerated. Are they paid based on capital appreciation? Look at how the business describes itself to investors in earnings calls and to regulators and filings. It's a holistic, evidence-based judgment.
Okay, step 4. Is fair value reliably measurable? This isn't just about guessing. You need an IFRS 13 methodology paper and an agreed valuation calendar.
Yeah.
Step 5. Is the election available? Meaning, are you making it at initial recognition when you buy a new asset, or are you using this one-time transition window?
Right.
And step 6. For each reporting entity, is the investment held as part of that activity? That's the asset level test, hurdle 2, to get into the operating category.
You must build and keep the paper trail for all 6 steps for every single asset. Your auditor will demand it.
Now for the timeline, part 10, the 12-point action plan. I'm looking at this list, and honestly, my blood pressure is rising just reading it.
The timeline is extremely aggressive, even if 2027 feels like it's far away.
Let's break it down. Phase 1 is immediately. What are we doing today, right now?
Step 1. Build a complete exhaustive inventory of every single associate and JV across the entire global group, mapping exactly which legal entity holds each one.
Big job.
Step 2. Run that 6-step checklist at the holding entity level and categorize them as yes, no, or borderline. Step 3. For those borderline cases, get a written technical position paper drafted and agree on the direction with your auditor before you do any more work.
Okay, then we hit phase 2. Next 30 days, step 4. And this is the one that absolutely freaks me out. Commissioning fair values for January 1, 2026 and December 31st, 2026. Wait, you're telling me if I make this choice in October 2026, I have to hire a firm to tell me what a private, unlisted company was worth 10 months ago?
Yep.
How is that even defensible under audit standards? Doesn't hindsight bias completely corrupt that number?
That is exactly why Sharik Sadiq flags this for the next 30 days and why you are right to be freaking out. Valuation lead times for complex, unlisted assets are incredibly long. Valuers absolutely hate retrospective valuations because, as you said, avoiding the bias of hindsight is very difficult.
It's basically impossible to pretend you don't know the future.
You have to pretend you don't know what happened between January and October. You need defensible, level 3 inputs, discount rates, cash flow projections based only on what was known on that specific historical date. If you wait until year-end 2026 to start this process, you will not get it done in time for your comparative restatements.
That sounds like an expensive nightmare. Okay, phase 3. Next 60 days, steps 5 and 6.
Step 5 is modeling the outcome on both bases, running parallel models for the equity method and the fair value option. You need to see exactly what happens to your operating profit, your net assets, and your key ratios.
Gotta know the numbers.
Step 6 is taking those models and stress testing every single loan covenant and executive incentive plan to see if the new numbers trigger a breach, a technical default, or an accidental massive payout.
Phase 4. Next 90 days. Steps 7 and 8.
Step 7. The board of directors or the audit committee must take a formal, documented, minuted decision to make the election. It is irreversible, so the board must sign off on the strategic reasoning.
Okay, get it in writing.
Step 8 is completing the IFRS 18 classification analysis for each reporting entity, deciding exactly which buckets the gains will fall into across the group.
And finally, phase 5. Before year end. Steps 9 through 11.
Step 9. Reconfigure the general ledger, update the consolidation tools, and build the new IFRS 18 category tags into the software. Step 10. Draft the transition notes. The IAS 8 change in policy disclosures, the complex IFRS 13 valuation sensitivities. Draft them early. Do not leave them for the audit crunch.
Please don't.
Step 11. Prepare the investor communication strategy. You need a detailed bridge showing analysts exactly how you got from your previously reported operating profit to the new restated figure, clearly separating the presentation effects from the measurement effects.
And step 12 is ongoing. Monitor local standard setters, especially for IAS preparers in India, waiting for the local equivalent of IFRS 18. I'm looking at all 12 steps. That is a massive, highly disruptive amount of work just to change a couple of line items on a balance sheet.
It is a phenomenal amount of work, but you have to remember the alternative. The alternative is having your core business performance forcibly hidden in the wrong section of your financial statements for the rest of your company's existence. The effort is mandatory if you want to tell the true economic story of your business to the market.
Let's move to FAQs and final nuances. We've covered the main roadmap, but there are always edge cases and potholes. Let's do a lightning round of the key questions from Part 11.
I'm ready.
Question 1. Is any of this actually compulsory? Do I have to use fair value?
No, it is entirely an option. An eligible company can absolutely choose to stick with the equity method if they prefer the stability and lack of volatility.
Okay, but what if I tried, I don't like the volatility? Can I switch back?
Absolutely not. The transition opportunity is a strict one-way street from equity to fair value. Once you elect it, you are locked in.
What if we have an unlisted associate in a volatile emerging market and we simply cannot obtain a reliable, defensible fair value?
Then you don't elect it. IFRS 13 requires observable and unobservable inputs that can be verified. If it's a complete black box and you cannot support the valuation methodology every single reporting period to your auditor's satisfaction, fair value is not a realistic option for that specific investment. Stick to the equity method.
Here is the big one. If a listener takes only one thing away from this entire deep dive, what is the one single thing they must get right.
Separate the two tests. Eligibility is about the entity holding the asset. Classification is about the entity reporting the results. Answer them in that exact order, in writing, with evidence for every single investment. If you conflate those two concepts, if you assume eligibility guarantees operating classification, your entire IFRS 18 presentation will be fundamentally wrong.
That is incredibly clear.
It's the most common failure point and the most dangerous assumption to make.
We've covered an immense amount of ground today. Let's try to synthesize this. We are looking at the overarching theme found in the guide's quick reference in Part 12.
The overarching theme is a long overdue move away from arbitrary labels toward actual, verifiable business realities. We are finally moving from a world where your accounting depended entirely on whether a lawyer 50 years ago called you a mutual fund, to a world where your accounting depends on what you actually do every single day to generate returns. It is a very small textual amendment in the standard, but it has a massive global economic footprint.
And the parting advice from CMA Sharik Siddique's guide is stark. The companies that will survive the 2027 transition are the ones finishing this analysis in 2026, not the ones starting it in 2027.
If you wait until the implementation year to start mapping this out, you will be drowned by the retrospective valuation requirements, and you will likely trigger covenant breaches that you didn't have time to model in advance.
As we wrap up, I want to circle back to where we started. We talked about how we crave the precision of a medical x-ray, broken or not broken, profit or loss. We want the numbers in the annual report to feel like undeniable facts.
But this amendment and the transition to IFRS 18 exposes just how malleable those concepts really are. I want to leave you with a final thought to mull over. We've seen today how a company's underlying economics, the actual cash they generate, the buildings they own, the tenants paying rent, can remain completely 100% unchanged. Not a single physical dollar moves differently in the real world.
Right.
Yet, entirely due to this IAS 28 amendment and the stroke of an accountant's pen, their reported operating profit could literally double overnight.
Just by changing the lens we view it through. By switching from looking at the internal books to looking at the external Zillow estimate.
Exactly. So the question is, what is profit, really? Is it a fundamental law of physics, an absolute truth that exists independently in the universe? Or is it just a language we invented to tell ourselves a comforting story about value? And if it is just a language, how carefully are you reading the translation?
That is a fascinating and slightly terrifying thought to leave on. Thank you for walking us through this incredibly dense but vital topic. Make sure you check out Sharik Siddique's full guide to run your own diagnostics. Until next time.